If you are a B2B leader spending millions on go-to-market programs, but relying on some form of attribution to tell you what's working, there is a high chance you're being misled. Maybe you feel it in your gut, this uneasy feeling that you can't really explain. None of your dashboards tell you the real story, and your answers have never been more elusive, which is a terribly uncomfortable place to be in. The hard truth is that attribution is more part of the problem than the actual solution. Let me explain what I mean. We have been talking about the limitations of attribution for more than half a decade, and the problem today is just as pervasive as it was back then, potentially even more so now with AI in the picture. Buyer behavior gets harder to track literally every day, and we're still measuring 2026 buyer behavior with a measurement system created in the early 2000s, if not even before then. Only now, more marketing executives are starting to realize the pitfalls of this, but they still don't have a clear alternative, which is the hardest part. But when it comes to attribution, regardless of the model, whether it's first touch, multi-touch, or last touch, most of what actually matters in marketing is increasingly hard to track. And companies keep doubling down on the same flawed measurement approach, expecting different results. So in this video, I'm going to break down why virtually every attribution model leads to bad decisions, what happens when you compare what the software reports versus what's actually driving revenue, and what to do instead so that you can actually understand where your pipeline is coming from. All right, let's get into it. Most companies treat attribution as the answer to proving marketing ROI, but it's actually creating a vicious cycle that feeds the very problem they're actually trying to solve. Here's what I mean. When you set up an attribution model, first touch, last touch, multi-touch, U-shaped, W-shaped, whatever you are doing is assigning a weighted credit to different channels and interactions based on where they may have happened in the buyer's journey. That's if those signals or channels can even be tracked at all. The problem is, whatever model you pick can completely change the answer. These models are extremely generous. One model might oversubscribe credit to a channel, you switch model, and it assigns more credit to something entirely different. And on top of that, half the interactions that matter the most today in 2026 can't even be tracked. What actually influences a buying decision never even gets captured by attribution software in the first place, which is exactly why leaders struggle to get buy-in for brand investments, arguably the most important investment and the one that's next to impossible to measure attribution against. So what happens is that you end up with a system that gives you a different answer depending on which model you choose, while most of the picture that matters the most is entirely missing. And then what happens is that companies and, ELTs build their entire financial models and investment decisions around that incomplete, inconsistent data. That is the problem that most CMOs and VPs face today. Let's be honest. The real reason marketing measurement has become such an obvious problem is because of market headwinds over the last many years. When budgets were growing year over year, nobody questioned attribution because there was enough money to invest broadly. So if one model said paid search was driving revenue and another might, say it was events, it didn't matter that much because you could realistically have the budget to fund both and nobody asked questions. But now companies are being held to much tighter cost efficiency standards. Boards and CFOs are asking harder questions about where every dollar goes and what impact it's driving for the business. I have said it before, and I'm going to say it again. The smartest, most strategic marketing leaders no longer think about volume and activities of marketing programs. They are operating on discernment and getting a clear picture of reality and not all the noise that actually comes with attribution, making them feel like they need to do more. And when you actually need to make trade-offs, when you need to decide what to cut and what to double down on, that's when the flaws in attribution become impossible to ignore. The model cannot give you a reliable answer for where to invest or where to pull back your budget on. A perfect example of this was with a $250 million ARR cybersecurity company who worked with us recently. Their whole strategy was anchored on demand capture and driving revenue through free trials coming from paid search. So they spent millions of their spend on paid search per year. And they continued doing this because leadership insisted that it was the smartest marketing tactic and the easiest channel, obviously, to track conversions against. But when you actually look more closely and you look at the down funnel metrics, this motion was driving like horrible win rates, incredibly low value deals, and almost a negligible amount of total pipeline and revenue when you look at the complete picture. So what actually happens when you play this game is that attribution will push you to lump all of your marketing investments into one narrow area, usually, which is capturing demand, because it's the easiest and it's the clearest thing to track. But when you measure marketing by lead source origin, or even the last conversion prior to opportunity creation, did this deal show up as, coming from Google search, a paid ad? Was it a direct web visit? Like, what was the last thing that happened? And when you do this, you're reinforcing all of your marketing spend into just one very narrow moment of when a conversion or signal took place. With last touch, you're funneling everything into whatever captures buyer demand at the very end. And then the same thing with first touch. Doesn't matter. The model tells you a different story, whatever way you slice it. But that moment of conversion is a tiny fraction of the entire process, and forcing your marketing budget to optimize only for that means you're neglecting everything that potentially got the buyer there in the first place. And we're assuming that this signal or trackable interaction even mattered in the first place when you're ascribing credit to it. All right, let's talk about something called the attribution mirage. What do we mean by that? The fundamental limitation of attribution software is that it can only measure what creates a trackable touch point in your system. So it could pick up Google searches, paid ad clicks, website visits, email opens, form fills, and even offline event interactions, anything that generates a data point in your system. But it completely misses the things that actually influence somebody to want to buy in the first place: brand awareness. And think about how important brand reputation and credibility is here, most of which that isn't generated through a trackable source in most cases, especially in the age of AI. So think about how a B2B buying decision actually happens. Somebody hears about you maybe on a podcast over the course of a few months. Maybe a colleague mentions your product in Slack. They might see your CEO speak at a conference, or you might have a brand presence there. They read a LinkedIn post that resonates. Maybe they don't even click anything. They read about you in an LLM. And then one day they Google your company name and request a demo. Attribution software in this instance sees one touch point, organic search, that happened at the very end. But everything that drove that decision in the first place goes invisible. Because of this, the channels that are easiest to track get all the credit, and the channels that are hardest to track get none, regardless of their actual impact. So things like LinkedIn thought leadership, podcasts, Slack communities, conferences your company didn't host but attended, word of mouth, internal sharing where somebody forwards your content to a decision maker within their company. None of those things get tracked or captured with an attribution model. And yet, for many companies, this is where a huge portion of demand is actually being created. So what happens when companies only look at what software attribution tells them? They keep dumping more money into paid search and their website because those are the channels that show up in the data. They cut content, podcasts, social programs, during downturns because the numbers don't justify the spend. In many cases, brand is hard to justify for a lot of CMOs and VPs. And so they end up going out to market with a motion that is heavily weighted towards capturing demand while neglecting the activities that create it in the first place. By the way, if you're a B2B SaaS leader and you don't have the data you need to understand what's creating pipeline and real ROI, that's exactly what we help with at Passetto. In just 30 days, our sprint gives you complete clarity into what's working, what's not, and where to focus. So if you're interested, just click that link in the description to book a call with us. Here's the key and where rubber meets the road. Let's talk about why revenue visibility and attribution are not the same thing. This is another issue we see constantly, which is that companies try to use attribution to answer questions it was never designed to answer. Revenue visibility and attribution are two completely different things, and most companies blend them together and expect to get the answer that they're looking for. Revenue visibility measures how buyers enter and actually progress through your buying stages all the way through to close one and even expansion. It tells you where the bottlenecks are, where deals stall, how long each stage takes, and what your conversion rates really look like at every step, including giving you insight into why your conversion rates tank at different stages in the first place. This is novel insight. Attribution will never give this to you. Attribution measures individual touch points and tries to map which channels or interactions contributed to a deal. They serve different purposes, and you cannot use one to replace the other. So the reason this distinction matters is that revenue visibility gives you operational insights that attribution cannot give you. It's not just a marketing analytics exercise either. It tells you how your SDR team is performing, how quickly leads are being followed up on, which I know is a big pain point for a lot of marketers, and where in the sales process you are the weakest. It also gives sales leaders the data to see which triggers lead to the highest pipeline velocity versus the ones that go nowhere, actually validated by data, not anecdotes. And it gives your finance team cohorted data for revenue planning without anybody having to stitch together spreadsheets across different systems. And yet the vast majorities of companies don't have this set up properly yet. Then they try and answer these operational questions with multi-touch attribution, and it doesn't work because, like I said, attribution was never built to answer that question. Another thing is that attribution can be relatively easy to implement, but hard to make sense of, because it basically tells you everything is working in many situations. When every channel gets some credit, it's really hard to figure out what's actually moving the needle. Revenue visibility is the opposite because it can be harder to track and build, but once it's in place, the insights become so much more clear. Let's talk about why who sourced this deal is the wrong question to ask, because that comes up a lot. There's a debate that happens inside almost every B2B company, and it goes a little something like this. The SDR leader says, we need first touch attribution because when our team prospects somebody into a meeting, we need to get credit for that. Marketing, on the other hand, might say something like, but there was a marketing touch within our look back window of 30 days. So that deal should count as a marketing source deal. And then maybe you have like a partner team that says, well, the partner team brought this lead in, so it should be tagged as partner sourced. Every team in this scenario is fighting for credit, and the attribution model is what's actually creating that fight in the first place, especially if you're using a one-dimensional model like first touch or last touch that's only looking at one thing. The issue is that this debate treats revenue creation like a single action by a single team when it's simply not like that, especially not in 2026. SDRs take buyer signals like an MQL, a demo request, or even an intent signal from a third-party tool, and they convert those into meetings and pipeline. That is their job. Marketing, on the other hand, creates, curates, and delivers those signals to the SDRs. That is their job, not exclusively, by the way. Both of those things have to happen for pipeline to get created. Comparing them against each other and arguing about who gets credit doesn't make either one better. Every company shows this challenge, but the best performing teams move beyond credit and look for the unique patterns of things before and during pre-pipeline outreach that lead to the strongest pipeline and revenue outcomes. So instead of splitting credit, what you should be doing is actually looking at all of the signals together as like one picture, using both components of attribution to understand behavioral engagement patterns that take place, but also understanding outside of that, the unique triggers that actually initiated the outreach to start. This might include looking at first-party signals from your marketing efforts. Those can be triggers, and third-party signals from your data providers. Those can also be triggers. But it's not just one over the other. It's all of these things need a place to be tracked in and evaluated together as inputs into your pipeline creation process. And then separately, you measure how effectively your prospecting team converts those prospects into meetings and pipeline, depending on what triggered that process to begin in the first place. And then, and only then, you can layer on signals or attribution to understand what people might be doing after you understand the fundamental things that create pipeline. This way, you can evaluate the quality of both your prospecting triggers, the things that initiated outreach, as well as the trackable signals that you can measure without it being a turf war. And then that's where you can evaluate the effectiveness of your prospecting without it being confused by which department gets the credit, because you're looking at marketing impact separately and in parallel with that. So what do we recommend doing instead? If attribution leads to bad decisions, then what should you actually do? We get asked that question all the time. The first thing is to stop treating attribution as a primary KPI. It should be ancillary, something that you can look at for directional context, but not the thing that you make major investment decisions on. The sharpest and most strategic leaders use attribution for this purpose. It has a place in the ecosystem, but just a right place. The reason is simple. Attribution will always be incomplete. It will always miss channels that matter, and the model you choose will always bias the results in one direction or another. So knowing that, you can still use it as one input, but it shouldn't be the driver of your investment decisions. The more important thing to fix is the underlying data so that you can actually see the full journey a prospect takes, and understanding that messy middle between lead created and opportunity created, because that is where the most novel insight lives for decision makers, especially CMOs, trying to figure out what's working and why things aren't working. Most companies right now are trying to understand their pipeline by looking at attribution reports from one tool, conversion data from another, sales activity from Outreach or SalesLoft, and then they try and stitch it all together in a spreadsheet or in, Looker or BI or something like that. And this is where things fall apart, because the data is so fragmented across systems and objects. Specifically, definitions are inconsistent, and by the time you've pulled it together, you still struggle to have a clear picture. So what we recommend is having a unified view that connects your CRM data, your marketing automation data, and your sales outreach data into a single stitched together data set, so that all of that data is connected to business impact, which at the end of the day is pipeline performance and revenue generation. That way, you can see the full path from the very first thing that you can track of a prospect doing to whether that's, visiting your website, engaging with content, or being prospected to by an SDR, all the way through to when they become a customer or disqualify out of the process. And then you can understand why. So at Passetto, we have a unique but also simple framework for this process. We call it the GTM Factory Framework. And we have a methodology for how each stage works in that process. So engagement, prospecting, and closing. So those are the 3 stages that we recommend tracking to give companies the complete level of nuance and detail that they need so that marketing can clearly tie activities to down funnel outcomes. So when you have that unified view, the questions you can answer change completely. So instead of saying which department gets credit for this deal, you can ask what sequence of signals and activities lead to the highest win rates. Instead of saying, is marketing source pipeline up or down this quarter, you can ask more strategic questions, which is where in our process are we losing the most deals and why? And what can marketing do to change this? You can see which unique combination of signals and prospecting triggers actually lead to quality pipeline and which ones just create noise and burn both budget and headcount resources. And if somebody handed you an extra, say $1 million tomorrow to go invest in pipeline creation, you would know exactly where to put it. Most companies cannot say that right now. And that is the biggest gap. So if you want revenue visibility, like we're talking about, and to see what's actually creating pipeline for your company, as well as what is underperforming, that is exactly why our pipeline growth sprint at Passetto works. We give you a comprehensive breakdown of your entire go-to-market system, what's working, what's not, where to focus, and it's all backed by the data that you can trust. It's in your system. We pull it together. So just click the link in the description below to book a call. We'll walk you through exactly what we do and why it works and see if you're a fit. If you want to see the best go-to-market strategy that's working today, then watch this next video.